um, we actually had a positive equity.
Mhm. Equity was a positive. It went up by 150.
Hmm.
So the question is, if
Is that
yeah, go ahead.
is that what you're asking, or?
Well, what we're asking is like, so, there's different ways to make your assets go up. Okay. So if you're a sales organization and you want to increase your assets, right? You can go get a loan. That's one way to do it, right? You can go get a loan and then you get cash, right? Another way to do it is to go sell part of your company so that your equity actually goes up, right? So in this case, it looks like the organization got more liability, meaning they got more debt. This is essentially debt.
Oh,
So they took out $100,000 of debt, and then they actually got more equity. And so that equity, if you look at the difference here, right, the equity went up by 250. So the only amount of asset change that made it was 150. So they're basically showing you that they had to borrow money to get part of the assets, is what it's showing. So the simple rule is when liability changes, when liability increases, it means you have more debt. When liability decreases, it means you don't have as much debt. Because that's what this section of the balance sheet is. It's all about debt, okay? Pretty much, right? So what it's trying to make you start thinking about is when you increase your assets, what does that mean? How does that impact your liabilities and your equity? And sort of you have to, it's a little bit of a problem that you have to solve and think about, okay? This is just the first problem. Let's keep going, and then hopefully it'll become a little clearer as we go, all right? So we have the next problem then is about, you have an equity balance, okay? In this case, we'll say 1.5 million. We'll just do 1.5, okay? Actually, this is in millions. Let's just go ahead and do it in millions. 1.5 million, okay? That's what that stands for. These are gonna be in millions, okay? So I'm gonna say 1.5. All right, and that's the beginning of the year. So let's go ahead and put that beginning of the year. Let's see, beginning of year, okay? And then I didn't spell that right, did I? Okay, well, forgive me. Okay, so end of year equity balance, we'll say, is 2 million, okay? All right, here we go. So this is the end of year. Now, but it's basically saying that if you're in this example, we have a nonprofit. Okay, so that means there's no taxes, right? That's essentially what it means when they tell you something's a nonprofit. You don't have to worry about income taxes. Okay, if it's a for-profit, then it is something that you think about. Okay, that's the importance of that. So it's a nonprofit. Okay, and so now it's saying what was its income for the period? Okay, what was its net income for the period? So if your equity went up, now what's the difference here? It went up by how much? It went up by $500,000, right? If nothing else changed, then what it's saying is variance here must have been related to net income. Okay. So in this example, this change would have been purely net income. So what we could do is we could say that net income was $500,000, right? And therefore, the end of year equity was 200 because you're just adding it. Okay. So the question is, what kinds of things can you make equity change? Do people have a sense for what types of transactions can make your equity increase or decrease, for that matter? But anybody have an idea on that?
When you have a new owner.
Yep, that's absolutely one way. So somebody can invest in your company, right? And they can give you they'll give you cash and you give them equity, right? And if it's, often that's in the form of stock, right? So that's one way is you can have an investment, an investor, an owner. And then the other way, the other big way is that you
Revenue.
get net income from, you know, one period to the next, or over a period of time you generate income, and that income that you generate gets recorded into your equity section. So if you think about it, your income statement is for 1 year, okay? It's all the things you do in that 1 year. At the end of that year, you close out your income statement into your equity section of your balance sheet. Your equity section of your balance sheet is where you store all your income from all the years of your operation. And you're accumulating all that income. And if you decide, if you're a nonprofit, then, you know, you might decide to, you know, possibly, what you're doing when you're building your income is you're also hopefully saving cash, right? And so there may be a point in time where you want to use that cash for some investment or something, right? The other thing, if you were a for-profit, you may want to pay dividends. So if you have a big equity balance, you might want to pay your stockholders, your shareholders dividends. And those dividends would be coming out of your equity, okay? So that's one thing just to keep track of. All right, so then what this example now is saying, well, let's add a couple other things here. So if this company, now we're going to say this company is an investor-owned company, so it's a taxable entity. So if now, let's assume that scenario where there's no dividends. Okay, I'm going to just use the same numbers over here, but I'm going to add in here dividends. Okay, and then we also have stock sales. Whoops, stock sales. Okay. So again, you know, these are kind of the three things that happen in your equity section. Okay. These are the three things that can happen. You can, you know, you have net income. I'm going to make that 0 for now. Dividends or stock sales. Now in the example, it says if you have, let's see. If you have 200, this is saying 200,000 in dividends. Okay, so let's go ahead and use an example of 200,000. That's fine. So if you're providing dividends to your shareholders, what does that mean to your equity? Is that increasing your equity or decreasing your equity?
Decreasing it.
Right? So that's a negative 200 in this example, right? So we'll just go, sorry, negative 0.2, because that's in millions, right? Negative 0.2, okay. So now again, our total equity change here, right? We're not changing our total equity. It's still 1.5 million, right? Is what it's changing from one year to the next. Let's do, you know, total change. Okay. If we know that dividends have been distributed and that equals 200,000, what then is remaining? What would we what would our net income have to be if we didn't have any stock sales? It would be 0.7, right? 7 and negative 0.2, it's 0.5, right? So you would have had to generate 700,000 in net income, and then pay out 200,000 to get to a total change of 500,000. Okay, it's pretty simple math, I think, right? You just have to know, you just have to be aware of what happens in your equity section. And these are pretty much the three things that can happen. Dividends are always going to be negative. Stock sales are always going to be positive, right? So let's go to the last scenario then. And this one says, in this example, we're going to go ahead and take these out again. For example, you have 200,000 in dividends again, okay? Whoops, sorry. Putting it in, it's 0.2, negative 0.2, right? And you've had $300,000 in stock sales. So now, so far you've accounted for a variance of 100,000, right? but you know your total variance is 500,000. What would your net income be then?
400.
Somebody said 400. Okay, if I put 400 here and I add these up, that equals 500,000, right? So there we are. We just did it. So that's basically what you have to just, you know, kind of play around with. You know that your stock sales are always going to be an increase because you're adding more equity. You sell stock, they own part of the company, but they're giving you something in return. That's usually cash, right? So then that's going to increase your equity. Dividends means you're gonna distribute part of your income, and then the net income is the amount that you have earned for that year, okay, on your P&L. All right. Okay, let's keep moving. And we've got 4.3. So this one is an interesting one, isn't it? Did you guys try this problem?
Yeah.
Was it hard?
No.
Okay, so you got it?
Yep.
Does anybody actually have it in Excel? Did anybody do this in Excel?
Not yet. Not me.
Yeah.
No.
Not yet.
Nobody?
No.
Okay. I was going to say, because I could share the screen and you could take, if somebody wants to show me what they did. No takers, huh? Okay. All right. So let's go ahead and do this now. So here we go. We've got a December 31st, right? December 31st balance sheet 2014. Okay, that's where we're starting. And we're reconciling down to a December 31st 15, okay? And we've got the usual balance sheet items, assets, liabilities, and okay? All right. And then the same thing goes for here. We've got assets, liabilities, and equity. And then we're going to say, so then the question is, what happened? Here's your beginning sort of balance. Here's your ending balance. Essentially, that's what this signifies. You got a beginning and you got an ending. Okay.
Mm-hmm.
So that just means that every year end, you're going to have a new snapshot on your balance sheet and say where you are. So this is December 31st. This is the snapshot of their balance sheet. The next year, here's the snapshot of their balance sheet. And then the question is, what changed from year to year, right? And so that's what this next. It's the what happened during the year, right? During 2015, what happened? And what they're going to give you is they're going to give you as sort of plug in revenue, P&L, right, and expenses. Okay. Now, these are all in the example that I'm going to do is these are all non-for-profit agencies. So they're not going to have any what? What are they not going to have if they're non-for-profit?
Taxes.
Dividends.
Taxes and dividends, yes, but taxes. So if we look at the down here, we don't have to worry about taxes. So then that just means this answer down here is net income. Okay, net income. Okay. All right. So what it's giving us a couple of the numbers. So I'm just going to go ahead and plug in some numbers here. Just to have some again. Oops, that's not net income. Sorry. Let's do that. This is going to be 300. Whoops. This is let's do 400. And we'll do 500. Okay. I'm going to do, I like to have my, I can see that. All right, okay, so now we're going to do a few more. We'll fill these in. Okay, and liabilities, we'll just put at, that's equity. All right. Let's do the first one here, okay, just so we can get an idea. So in this case, you're going to solve for the equity number. So how would we do that first? How would we solve for equity?
Subtract your liability from your assets.
Mm-hmm. Right. So it's this minus this, right? Okay, so we got equity of 55. How about here? Same thing. We just did it inverse, right? it's this,
Add the two
this,
together.
right?
Mhm.
And, right? Did
Right.
everybody get that? Okay. Now, in this example, total expenses are, I'm going to say actually, we'll say total expenses are, instead of four, I meant to say 400. All right, so if total expenses are 400, we know that our equity changed by how much? It went up by how much?
5,000.
Wrong way, sorry. 60 minus 55 is 5,000, right? It went up by 5,000. So our equity changed by 5,000. We're a nonprofit. We don't give any dividends. We don't do any shares of stock. The only reason our equity section of our balance sheet is going to change is because of net income, right? So we know what our net income is then. It's 5,000, right? We know that. That's what the change is. So that's 5,000. 5,000. What's our revenue then?
$405.
395. It's going the wrong way, but it's sorry, it's plus, not minus. Sorry, it's 4 plus, right? Yeah. So it's 405. That's our revenue, correct? So we know that revenue 405 less expenses of 400 equals $5,000 worth of net income, and that's what's changing here. Okay. That sort of gives you an example, I think, about how all of these would work, right? Does anyone want to go any further on these, or think that's pretty cool?
Probably moving to the next one.
Yep. Okay. Let's move to the next one.
Okay.
Okay. So the next one, selected account balance. Okay. Here's selected account balances. Warren Clinic. All right. And they're in alphabetical order. And so we want to create the balance sheet, right? So we've got the accounts. I'm just going to kind of summarize this. Accounts payable is the first one. We've got, well, first of all, actually, before I put them on here, why don't you guys tell me how you would sort it out? You want to do that for me first? What would you put first on this list? 4.4. Does everyone have that one? What goes first at the top of the balance sheet?
Your assets, your current assets.
And what's the first thing that goes in the very, very top?
Cash and cash equivalents.
Mm-hmm. Okay. So cash is the first thing. Because why is it always the top?
Because it's the most liquid.
Good job. It's the most liquid, all right? So it's always in order of liquidity, okay? So then we said, right, in this example, we don't have any cash equivalents. So what would be the next item?
Accounts receivable.
Accounts
Sorry?
receivable.
Accounts receivable, okay? So I'm going to go AR, and it's net. So does anyone know what net means?
Minus all the allowables and discounts.
Yeah, all the allowance for bad debt, right? So there could be an allowance or provision for bad debt. So usually when they talk about net, it's net of any provision for bad debt, okay? What's next?
Other assets.
Okay, other assets. And then let's see, the other choice would be net, okay, yeah. So let's just go ahead and put that. Whoops. Sorry. Usually,
What about long-term investments?
yeah, so what usually you do when you think about it, the other assets are often accruals. I'm sorry, not accruals, but like deposits or things like that. So usually they are very long term. Often you'll see deposits put on an asset, as an asset. So the more than likely those other assets could actually be a little bit below. I would guess the next thing I would guess would be the net property, plant, and equipment. So I'm going to put that. And that's also referred to as fixed assets, okay? And that is often referred to as net as well. So do you know what that would be net of?
Depreciation.
That's right, net of depreciation, okay? Good. All right, and then we probably would put our other, the next item, other assets. And last but not least, what would we put?
Long-term investments.
Long term, that's right. Because those could be multiple year investments, okay, that you can't get out of easily. All right. Okay, so then let's go. So that's your total assets, and then what would be your total liabilities? What do we start with?
Current liabilities,
And what would the first one be?
accounts payable,
AP. Okay, great. And anybody got an idea what would be next?
Long-term debt.
Yeah, that's there's not much on this balance sheet, is there? Okay, great. And then after that, of course, would be that's your total liability, right?
yeah,
Yeah, and here's your total asset. Okay, and then the next thing would be, last but not least,
equity,
equity. Okay, great. Now let's say your total assets in this example were 500. I know that, just saying. And then the total liabilities were 200. What's your equity? How do you calculate it?
300,000,
What was that?
300.
You're just subtracting, right? There you go. Boom. Okay.
One question.
Yep.
This one had other long-term liabilities. So is that also included in total liabilities?
Oh, I missed it. Thank you. Okay, so let's put that in here. Good job for catching that. Yeah, so other long-term.
Yeah.
That goes there. So again, it sort of depends on what it is, but often those will go, the long-term debt means anything that's over a year. Okay. And then, when you talk about other long-term debt, you could have something that maybe, that's payable, holding someone's deposit, let's say, and they have a 5-year rent term. That could be, something that's 5 years that you're holding. So often the other goes below is the way I look at it, but it's not always 100% that way. Okay? But thanks for catching. Was that Ashley?
Rachel.
Oh, Rachel. Okay. Thanks, Rachel. Okay. So should we move on to the next one?
I just had one clarification question.
Sure.
When we talk about current and long-term, I noticed in the book it uses like interchangeably current as being, less than 1 year or being payable in 1 year or one accounting period.
Mm-hmm.
Are those interchangeable, or are some accounting periods going to be in terms of like quarterly, or is it a different time frame?
No, usually it's only a year is the way that I've always seen it.
Okay.
So it's current would be, a year. And so so I think that's the only way that I've ever seen it. So that's a good question, but I think for the purposes of what you need to worry about, and there's always an exception for the purposes of what, we need to think about here. I think we just say long-term is anything over a year. Yeah.
Okay, great. Thank you.
Yeah, no worries. Okay, so we'll move on then. So now we have a balance sheet example. This is the 4.5 balance sheet example in the book, okay? And it's, so let's just talk about this one. It's asking how did the two balance sheets differ, right? So there's an exhibit 4.1 that has a balance sheet in the book. So if everyone can just take a quick look at that one. It is on page, let me find it, unless somebody else can find it first.
122.
Sorry?
122, page 122.
Page 122, here we go. All right, so can anybody point out the differences in balance sheet in example in problem number 4.5 and the balance sheet on page 122?
The main difference that I saw is that the one that's on 137, I think, or whatever page, the actual question one, it's a not-for-profit organization, because it includes the fund accounting, the unrestricted net asset. So that for me, as soon as I saw that, I said, okay, that's a not-for-profit, versus the other one, the 4.1 example, was a for-profit because it just had a standard net asset account.
Mm-hmm. That's good. Very good. Any other things you can find?
The reporting periods are different. There's two different time periods for the first one.
Yeah, and I think that's just showing you comparing the current period, which is 2015, to the prior year. Often balance sheets are presented that way when they're issued as financial statements, just so people can see and compare how they've done over time. And this one, the way that it's presented is only the current year, so that's definitely true. And let's see, anything else? How about the numbers? Do the numbers tell you anything differently? Anything you notice right off about the numbers? Maybe the way they're presented? So it's always important when you're reading a balance sheet or an income statement to see what the currency is presented as. Is it in full dollars? Is it in thousands? Is it in millions, right? Because that can really mess you up, right? If you're thinking that this, like for instance on page 152, if you're thinking that this is in full dollars, then you're going to be quite off the actual values, because these are actually in thousands, right?
And also 4.1 is thousands as well, right?
Both of them are.
Oh, it is in thousands. I'm sorry. You're right. Thank you. Good point. Good pointing that out. So that's not a difference, but it's something to be aware of anyway, but it's not a difference. Okay.
I had a question.
Yeah.
For the one at 4.5, it says supplies. Is that supposed to be synonymous to inventories?
So supplies and inventories often are. So then there are certain supplies that don't go through your balance sheet. And those are supplies that you would be expensing as you buy them. And then there are other inventories or supplies that you would be using in manufacturing, like if you're a manufacturing company, or you're using in, hospital. Depending on the size and the amount, you would actually have those as supplies on your balance sheet. So they're going to be treated a little differently. But I think in general, in this balance sheet, it's called supplies, right?
Mm-hmm.
Right. So they're synonymous in this example. And that can be confusing too, because you'll also see supplies on your P&L, so sometimes that can be very confusing. But yeah, good point. Those are called different things here.
For the liabilities and net assets, for the problem on page 152, the order of accounts versus notes is different than on 122.
Right, because you've got accounts payable, accrued expenses, and long-term debt. And you're saying in this example, there are no notes payable on this other one, right?
There is.
There's a notes payable.
Mhm.
122? Oh, sorry, it's at the top. Gotcha. Okay. Yep. So what would that tell you then?
The liquidity of those counts is different for the companies?
It's a really interesting that they do it that way. It's probably the notes payable are due sooner. But I think that's a really good question. And to understand why those, because I have never seen it like that before, but I have a feeling it has to do with the fact that the notes payable are more current than the accounts payable, if that's possible. But yeah, so it's normally the notes payable are after accounts payable, so that's really a different way of presenting it.
So for us, when we give you any problem or during midterm, we should follow the format on 4.5 for liabilities.
Yeah, I mean, notes payable are going to be divided in the two sections, right? Depending if it's a long-term or a short-term note.
Right.
Really, that's the most important thing.
Okay.
I don't think it's as critical which comes first. I've just never seen the notes payable first, but I think it's not as critical. I think.
Okay.
Yeah. Yeah. So I think 4.5 is more of a traditional sort of way of bringing it out. Okay. Yeah, so I think that's the big differences there. I think you could also sort of say like one organization is a lot bigger than the other, right? You can see because this is an HMO and the other one we said is a clinic, right? And so some of the ratios are probably going to be really different. This clinic has net equity, net assets of only 54 million, whereas the HMO has assets of 2 million, right? And so it's definitely larger in that sense. But the current assets in the clinic are 12 million, and the current assets here in the the HMO, 2 million. So they're really different. The sizes of the businesses are really different, right? Also, so it's kind of interesting to know that. Yeah, it looks like this is a profitable business. The clinic, very profitable business, has lots of equity and a big amount of cash, right? But it also has a lot of debt, doesn't it? What's the debt amount?
100 million.
It's like $85 million, right? You see that?
As part of the total current
The
total
long-term
current liabilities.
the long-term
Liabilities, 100,000.
the total liabilities are 100,000, and the debt, which is the long-term debt, is 85 million, right?
Oh, yeah.
Portion of that company is using debt to finance. And if you look at this one, the debt is 4.2 million, the long-term debt, 4.2 million, right? Of their total equity. Total liabilities are 7. So a lot of their liabilities are in accounts payable, right? And not so much in debt. So that's also really different. You can see that, right? How the organization is sort of managing itself. Okay. Now there's the next couple questions are about the ratios. So these are pretty straightforward, right? The two types of ratios it's asking for here. Net working capital. Does anyone want to share what the ratio is for net working capital?
So it's calculated by doing total current assets minus total current liabilities.
Okay, yep, that's right. That's the net working capital, right? So in this case, it would be the 3.9, right? 3.9 million over the 3.4, or sorry, less than 3.4 million, right? That's your net. And what about the debt ratio? Anyone want to clarify that?
So that'd be the total debt divided by the total assets.
And is it debt over assets or is it assets over debt?
Ooh.
Debts over assets.
You sure?
I guess I'm not. If questioning it.
Anybody else know? Anybody else?
I thought it was liabilities over assets, total liabilities over total assets.
Mm-hmm.
Yeah.
Okay.
7751 over 90.
Be confident. Be confident in your answers. Okay, yeah, no, you got it. You got it. And then, so in this situation, do you have any thoughts about that? Because we're looking at 7.7 over 9.8, right? So what does that mean when you think about you have 7.7 million, right, in liabilities and 9.8 in assets? What is that?
That's going to be less than 1.
Liabilities over assets, right? Liabilities over assets. Is it going to be less than 1?
Yes.
Yeah.
Yes.
You're going to have 7.7 over 9.8?
Yes, that'll be less than 1.
Yep, it will be.
Okay. So then is that a good thing then? If your assets are higher than your liabilities, is that a good thing?
Yes.
Yeah.
Yeah.
So that's
So-
cash floating.
What was that?
I was just trying to understand it. So I was just saying they're still cash flowing.
So that's it's a healthy business, right?
Mm-hmm.
Yes.
That's right. Okay. Good. All right. And so those are pretty straightforward. This next 4.6 is also asking about the ratios. Okay. So we just did those. That should be pretty easy. And then it's asking about the balance sheet and how it differs as well. So I think we went through that in the previous page. I don't know that we need to go through that again, but I think you want to look at the numbers themselves, to see how they differ, right? How do the numbers differ? So what is it telling you about the company? Obviously, this company is different than the previous page from one big example or one big reason when you look at the equity section. Somebody want to just call that out quickly?
This is not in thousands.
Okay, it's not in thousands, right?
It's in the full dollar amount.
It's in full dollars. What do you see in the equity section that's different than the previous example?
As the shareholders. So it's
Right.
a profit.
Exactly. So it's a for-profit, right? Because it has common stock, and shareholders' equity is what they call it in this example, right? Mm-hmm. That's right. Okay. And again, you look at the debt, you look at the assets, you can get a sense for, how does it generate its profit, its assets? Does it have a lot of debt? Does it not have a lot of debt? In this example, it doesn't have a lot of payables. It's only $72,000 in payables. The debt's $1.7 million, right? It's a big amount of debt. The assets 2.5, and a lot of that is in property, plant, and equipment, right? And their next biggest area is, they have 100,000 in cash, and then they've got the short-term investments of 200,000. So they've actually invested their some cash in short-term investments to make some money, right? And then it has some accounts receivable. So yeah. Okay, so obviously it's an asset-rich company. This one, the one we're just looking at. So it's using its assets to generate profit, and it's used debt to buy those assets. Is what that is saying. Okay. All right. Okay, so we've got about 10 minutes left. Do you guys want to go, because I don't know if we're going to get through all of these in 10 minutes. Do you want to go to any particular one?
4.9, please.
4.9. Is that okay with everybody? 4.9?
Yes.
Okay. All right. Okay. I started this one a little bit because this is a really interesting one. So did anyone get through this one?
Almost.
Who is that?
Almost as well.
Almost.
Margaret.
Okay.
Yeah.
Do you guys want to walk us through a little bit of it? What I did here is I created a new problem, right? This one is not, it's the same sort of situation, but it's not the same numbers, okay? Because I want to make sure that, again, that we're thinking about this little differently, right? Or not just going through the problem, but actually thinking through it. So the first question was, I set up the balance sheet here, right? And what I tried to do here was, put our equipment and accumulated depreciation as a separate item, because I think that I don't know if anyone got stuck on that, but in order to figure out what your fixed asset net of depreciation is, you have to actually net the two, right? And so this would actually it wouldn't be adding them, it would be netting them. So did everyone get that okay?
Yeah.
Okay. And so again, I just put some different values here. So I have total assets of 1.9 million. And then I have total liabilities of 725. So then the difference would be your equity, right? In my example, I have net assets of 1.1 million 77. Okay. So then they had various transactions over here, okay, that they had listed. And so why don't we see about how we would do each one of those? So maybe we can start with the patient billings, okay? So it's basically saying, record. These are recorded transactions that were recorded in the general ledger. So let's go ahead and see what they would do to both a balance sheet and an income statement. So let's build an income statement over here, okay, down here. Statement, okay. So, now the first thing, of course, in the income statement is the revenue, right? And then we have expense. We have net income, right? How that works, right? And I'm going to just make this a little bit smaller so we can see it all. Let's move you back. Okay. All right, everybody, can you see it okay? All right, so let's start with the first one, patient billings, okay? So we look at patient billings. What would that be on our income statement and on our balance sheet? Anybody want to take that one first?
Increase accounts receivable.
Okay, it would increase your accounts receivable. That's true, right? And what I might do is I'm going to reconcile my beginning balance over here to my ending balance. So I'm going to put, this is going to be my ending balance over here. So I'm going to be adding across, okay, with different items that I put in here. So I'm just going to make this be a sum, okay, of these, right? And I'm going to go ahead and put these back in here. Maybe I'm going to put them on here. I don't want them to get in my way. Okay, so this is a sum. We'll sum here, and okay. So the first one, patient billings, is you said accounts receivable, right?
Mm-hmm.
For one, okay. So does everyone, and so what else would it be besides receivable? Because remember, we're doing an income statement as well. So what does that represent, those billings?
Revenue.
That's perfect. Okay, so what we're going to do is we're going to book it into revenue, right? And then we're going to book it into accounts receivable. Okay, so it's kind of like the debit and the credit. So here it goes on to the revenue. It's patient billings is what we're calling it, right? Patient billings. Maybe I'll put it down here. Okay, patient billings. All right. Okay, now so that's that one. What's the next one?
That one's expense.
Okay, it's expense. What would be the other side of it?
Supply inventory.
All right. So this is the one that gets a little tricky, right? Because in this case, what I would say is the supplies are expensed when purchased. They're not inventory. So let's assume that's what's happening here, okay? So then if we purchase these supplies on credit, what does that mean?
Be a long term.
That means that we have to pay for them later, right?
Mm-hmm.
So instead of paying for them with our cash, we put them in our
Long-term debt.
Accounts payable, right? Accounts payable is where we know that we're going to get an invoice for something. We'll have to pay it later, right? It's our short-term payables. So every time we buy something and we can say, hey, just invoice me for it, right? And then we get the invoice and we have to pay it in 30 days. So that's what that one goes there, right? We're buying it on credit. And so we have to put it in our accounts payable, okay? And so it's basically one of our expenses and accounts payable, right? So then we have salaries, okay? So we have salary expense. Let's put that down here, right? right? So salaries, we owe 700,000 in salaries, right? Okay, but then what does this say? It says we only paid 650 in salaries, right? Okay, so now that means that the difference between what we earned and what we paid would be on our balance sheet as a payable, right? Because we still owe 50,000, don't we?
Yes.
Right? That difference is going to go on our balance sheet as a payable, right? So we need to put that also. Now, there are probably going to be something called other payables. It's probably not going to go in your accounts payable. So we could add something, but I don't think they have that list there, do they? They don't have that. So we'll just go ahead and put it there as 50. We owe it, right? Okay. Now, what it doesn't say the cash, because it's saying that it doesn't say we use cash to pay, but that's one piece that we're gonna keep in our minds as we keep going here. Okay. So let's move on to the depreciation, the annual depreciation. So how would that entry go?
It's an expense, no?
Okay, it's expense, right? There's 200,000 in depreciation expense. And what else does it go? Where does it go on the balance sheet?
Equipment.
It's accumulated depreciation, right? There's a space right there for it. So we're going to put it right there on our balance sheet. Okay, remember it's a negative. It's always negative, okay? But it's going to go there, all right? Okay. Anybody have a question about that? Just ask me if you have a question, please. Please speak up.
I still have a question about the salaries part. Sorry, if we can go back.
No, no worries. Yes, yes.
Earned and the paid, that seems a little confusing.
Yeah, so sometimes, you might have your payroll cutoff might be in between a period, right? So let's say that you owe somebody, you're paying, I'm trying to give it a real example of when you cut off, but the payment that you make to staff might happen, like if somebody leaves, say if somebody joining the company. Okay, here's a good example. If someone joins the company, you have them there for 1 week. They're not in the current payroll that week. They get paid the next payroll, because sometimes when you start a job, you don't get paid right away, right? You get a week or two. So that means that you earned the money. You earned the employee earned the pay. So we recorded on our income statement as actual salaries. We just didn't pay them yet, right? We didn't write them a check. We owe them that money. So we still have to record it on our balance sheet as a payable because we owe them. We didn't pay them. So that's the distinction. There sometimes are going to be situations where you're going to owe money, but you still want to record the salaries that they earned in the period. Okay, does that make sense?
So it's the same example that you used like a few minutes ago with the supplies on credit?
Yes. So the supplies on credit, like when you go to, often when you're a large agency, your vendors will allow you to pay them, in 30 days. So often what will happen is you don't have to pay with a credit card when you have a large organization. You can, you have a contract with a vendor, and the vendor will deliver the services, and then they will invoice you and you pay them in 30 days. When you get that invoice, you record it as a payable. You know that you have to pay it.
Would that be the accrual principle?
Excuse me?
Would that be the accrual principle?
Well, that's why you're recording it on your P&L, because you want to make sure that if you receive those goods, that you actually record them on your P&L as being purchased, but the cash is going to follow later, right? Mm-hmm. Mm-hmm. Okay. Okay, so then let's go on to bank loan. Okay. Let's talk about bank loan. So what happens with the bank loan? What would be the entries there?
Cash.
Yep, we get 200,000 in cash, right? And then what's the other side to that?
Payment.
Notes payable.
Before we pay them, what do we have to record it as? Yep, so who said that?
Notes payable.
Notes payable, right? Okay.
Yep.
200,000 that we have to record as a notes payable, right? On our balance sheet. It's a liability. We owe money. We owe that bank now. So we got the cash and we owe them money. So there you go, okay? Cash collections on billings. So we get $1.5 million now, okay? So what happens there is like we had 1.8 million in accounts receivable, right? So we know that people owed us 1.8 million. We just received 1.5 of that, right? So what happens then is what we can do is we'll go into our receivables and we'll say, well, these come down now, right? Because we got the cash, money anymore, right? But now we're going to put it in our cash account because we got the cash, right? So we have to just offset that. So our balance sheet stays the same. We still have 1.8 million. It's just moved from receivables to cash. And that's where we like it. We like it in cash, right? We always like it in cash. So that's fine. That doesn't change our revenue. Our revenue is still $1.8 million. We recorded that. It's just that now our balance sheet classification's changed a little bit, okay? All right, so how about estimated bad debt for the year, 45,000? Where does that go? Okay, so that's going to be an offset to our accounts receivable, right?
Yes.
Right, because that's where we talk about net. We're going to make this net now, right? Net. And so what we're going to see is, I'm going to go ahead and put it as a negative just so we remember it's negative. 45,000, right? Gets added here, right? And you know, in that same vein, I'm going to make this negative too, just to make it consistent. 200, right? 200.
How is that different from allowance for doubtful accounts?
Yeah, so it's a very good question. So this gets sometimes confusing, but the estimated bad debt and provision for bad debt are pretty much the same thing, okay? But when you actually have write-offs, so there's one of them, the first item is estimating how much bad debt you think you will have. That's what this is. That's a provision for bad debt or a allowance for bad debt. That's the assumption on how much you will think bad debt you think you will have. And then actual write-offs of debt is when you know that you're not going to collect something and you have to write it off, okay? So what normally happens with the estimated bad debt, this 45, is it actually does come out of your revenue, right? So when we book this provision for bad debt, we're going to take our revenue down as well. And so we'll go ahead and do that as a bad debt. And sometimes that shows up in expense, because have you heard of bad debt expense? Or it can be bad debt allowance. So in this case, I'm just going to have it as being a deduction from revenue. So that's that one, all right? So it's going here and it's going here. Paid on bank loan. So what do we do with that one?
Reduce cash.
We're going to reduce cash because we're paying on the bank loan. And so what else are we doing?
Reduce notes payable.
Right, we reduce notes payable, right? Because we're paying on that loan now. Right? Okay. And last but not least, used supplies and patient. Okay. So this one, interestingly, so this kind of goes back to, is the supplies inventory, is that what they actually had? Did they call it supplies inventory? Oh, they sure did. Yeah. So I think you were, Rachel, you were right. Supplies, the way that they're accounting for this, supplies is in fact inventory here. So you're right. So what happened is when we bought that 12,000, it went into inventory, right? It was 12, wasn't it? How much was the supplies again? Let's go back up here. 12,000, that's right. Okay. So that supplies would go into our balance sheet as asset. Supplies inventory right there. Okay. I missed that. Sorry about that. And then we're still going to leave it as an accounts payable, right? So what we do then is take it off the P&L. So it's in our P&L. All right. Now what it's saying here though is that we actually use the supplies. And that's when we have to move it. When we actually use it, we move it off of our balance sheet and we move it into our P&L. That's when it hits our P&L, when we're actually using them. Okay, so we will have a supplies item here, and that one then will be, what does it say, 15,000? So we're going to use 15,000 in supplies, okay? And then we have to take our inventory down by 15,000. Using the supplies, okay? Now that's a little confusing. Sorry about that. We can do another example on that one if we need to. Here, let me just make sure. Okay. So I think that got through these. Any questions on this? Let's do our sort of our net numbers here. So this ends up being sort of where we're at. Let's see if everything balances, okay? Because we have to make sure everything balances. Okay, so we're gonna do a sum, right, of all our assets. Okay. All right. And we're gonna do a sum of all our liabilities. Let's make sure these are all working on this way, because it should be working following these, right? Yeah. Yep. 2, 27, that's working. This is working. Okay. Oh, right. Okay. I think this is one maybe that we didn't do. So we have an allowance for doubtful accounts down here. And that one is showing up as a positive. You see that? And actually, if it's an allowance, it has to be a negative, right? So I'm going to change that sign just so that we can keep things straight here. That's a negative. And then the 45,000 was something we had actually, I'm going to put it there. That's going to be our allowance now. So we've got total assets of almost 3.5 million, a little bit over 3.5 million, right? And then we've got our total liabilities, right? And so now we have to figure out, well, what do we, our asset has to change a little bit here, right? Because we had made some money down here. So let's figure out what this is now. So we have our total revenue less bad debt, okay, is 1,000,007, all right? That's our total, and then our total expense right here, okay, is 915, right? So then what is our net income? It's going to be the 1,775 less the 915, right? That's 840. That's our net income. So now if everything balances correctly, the difference, once we add that 840 here, should be our balancing factor, right? So let's see if that works. Now, that's going to go into our equity. We're going to be adding, that 840 to our equity. It's added here like this, right? And so that is going to be a sum of this plus this, right? Okay. And then we're going to add together the 937 of our assets, of our liabilities plus our equity. Okay, so we've got 2209 here. Okay, so I'm just going to make sure that I didn't get something. And this one is a sum there of our. I thought there wasn't anything else. I don't think there. Make sure this is timing. Oh, okay. I think we got, oh, okay. I see. I think I see why. It's because we've got, something's double counting. I'm just trying to figure out what it is here. We had 1.5 here, 1.6. So we had total assets of 1.857. We added cash and accounts receivable. Oh, I know what it is. I think I know what it is. It's that difference of the salaries paid. Remember the salaries paid? So we needed to add that 650 as a cash out. We didn't do that. So I'm going to add that right now. So does everyone follow that? So when we paid our, yeah, okay, there we go. See how we balance now. All right. So there, we have total assets and liabilities of 2.9. Does everyone see that? I'm going to do it this way, make it maybe a little bit easier. There we go. And then we have assets of 2.9. Okay. They all tie now. That's basically all these transactions we did going through our income statement and our updating our balance sheet allowed us to tie out our assets and our liabilities and equity. It's kind of solving a puzzle, right? Every single one of them you just have to think about. There has to be 2 entries for every item, every transaction that we do. We have to have 2 entries. So whether it could be 2 on our balance sheet, 1 on our balance sheet, 1 on our P&L. We have to make sure that there's always 2 entries for everything we do. And I think that's once we make sure that all of those entries are accounted for, then we will, we'll be confident that we actually didn't miss anything. Okay? I'm not gonna do that. So any questions on that? Was that confusing, or did folks like that?
I think it might be helpful to rewatch your video.
How about you, Margaret? Did you feel like you got it?
Yeah, I think, yeah, I just couldn't balance it so far with my numbers.
Oh, you
So,
can't. Okay. Well,
I might have to watch this a couple of times.
Did you do the cash payout for between when the salaries were paid? Did you actually do that entry? Because that one I think people might miss.
I did, yeah. The paid versus the earned was the question that was stuck
Which
in my
one?
head. And the other one is the salaries paid versus salaries earned, which you explained. And the other one was the allowance for doubtful accounts, which I think I get now.
Okay.
Yeah.
All right.
So a question that was posted, I think by Margaret, is if you want us to show all the work, or are you just interested in the final numbers?
I think it'll be really helpful if you show your work. But at the end of the day, I'm looking for final numbers, because this is going to be very similar to what one of your test questions is going to be. So you really want to make sure that you know what you're doing here. And I think if you don't actually go through all the steps, it will be really hard to know, right? So one thing I can do for you guys is I can create a little model that allows you to do your pluses and minuses kind of like this, or else you create the Excel model. But I think having an Excel model will be really helpful when you plug things in, so you can kind of see where it is and add it up. So for those of you who are, who don't use Excel regularly, I strongly suggest you think about that, okay? And I can, like I said, I can set up a little model for you with some little test questions, but I think being around with this kind of thing where you have transactions and you have to plug them in and see what the changes in your income statement and your balance sheet are, that's going to be really helpful if you do that, a few times, okay? So how about you, Jenny? Did you feel like you kind of got it? You followed it a little bit? Okay. Do you guys want to have another session? Would that be helpful to do another session and maybe go through a couple more examples like this?
Yes.
Okay. All right. All right. Let's think about. We'll find some time to do that maybe this weekend again and see what we can do there. Okay. All right. And maybe I'll give you guys a little Excel spreadsheet that might help. Okay.
Thank you so much.
Okay. Great. Evan, did you have a question?
No, not about this one.
Okay. Do you have a question about a different one?
About 4.7.
4.7, because we didn't get to that one.
Mm-hmm.
But you want to, do you think you could join us for another session?
Yep, I will.
Okay, great. Let's do that. You can send me an email because I know that I have, I'm going to be checking in with somebody. I realized that I had another person I was going to check in with at 8. So I'm already a bit late for that. So, but we'll try to find some time this weekend maybe.
Okay.
Okay, guys. Thanks so much.
Thank you.
Thank
Night.
you.
Night.
Thank you.
Bye.